What if I told you that every single one of these trades was taken based on the same key level and using the exact same strategy? You'll also notice that they all have precise entries, almost sniper entries, and high reward to risk. And finally, each strong move begins with just 2 candles. In this video, I'll reveal my simple trading strategy that I use every single day using only 2 candles. Let's start. Now let's start with the steps, and I really believe that these 3 steps can be applied to your current strategy that you're using as of now or to your new strategy. I would say that these are universal. They can be applied to any setup that you have. So the direction, and that is optional, and we're going to go over this on the next slide. Why is it optional? And then choosing and picking the key level, and then finally the trade management. These are the 3 steps that I even build the edge model around. And I think these are the 3 must-have steps for any trading setup that you either having now or creating one in the future. So starting with the direction, you really want to be in the right direction, even though sometimes you don't. For example, when the market is overextended, then you cannot be with the direction. You can wait for a pullback, or you could go. So let's say, for example, if we are long and then we are just overextending all the way up, we cannot stay with the direction here. We cannot, go long here. This is just a bad price position. We either can wait for a pullback and then enter from here, or you can go short. So sometimes you can be against the direction and you're still going to succeed. And I'm going to show you how in the next slide. So for the direction, you can use the sweep method basically. And I'm going to recommend the video for you in the description. Basically, when we're not able to displace above swing high, so for example, here, we cannot displace above and then we just get rejected at the high, that means we can go lower. Now that is a way and a method to find the direction. Another one is the market structure. So we've been always talking about market structure. If we are creating higher highs and higher lows, then that means we can look for, that is an uptrend, we can look for longs here. And the opposite is also true. So if we have been moving lower just like this, breakout structure, we can look for shorts. So the direction, these are 2 methods. There are a lot of other methods that I teach in the Edge School in my community, and these are ones that are also easy to apply, but these ones are they can be enough to you. Now, when it comes to the key level, now we establish and we agree on the direction that, for example, we're looking for longs. Now, the next step is finding the key level on what exact level and zone we need to enter the trade and look for the confirmation, which is going to be the next step. So the key level, and one of my best ones and the one that I use almost every day, is an extreme level. We're going to explain it later. And then we have some other levels that I also teach in Edge School, but extreme level is my favorite one. And yeah, so this is what I focus on. However, I have some other patterns and some other levels that I also use every day. Then comes the trade management. So think about where to put your stop loss and then where to enter in the first place, the take profit, where to go break even. The entry would be the key level. That is one thing, and that is too obvious. The stop loss, a lot of methods here can be below the low, slightly below the low, leave some breathing room here. And then the take profit either on the same time frame that we take the key level or one that is lower, to be on the safe side. All of these are some methods that I've been teaching here. And then the break even, and that is just a personal choice. So you could go break even after a specific reward to risk ratio, or you could, after hitting your first key level or your first obstacle, then you go break even and leave the rest run. But mainly the focus for today is going to be the direction and key level, and mostly the key level. Just show you how extreme levels can be just the best level that you can use, how you can get snapper entries, and you will realize that the higher reward to risk will always come off an extreme level, because that is a level that if price goes there, it's not going to go back, and it's going to be the highest high or the lowest low. It's always of the extreme level, and that is the main focus of the edge model that we're going to be explaining today. Now, when thinking about the direction here, as I said, the direction is optional. However, it's always better to be on the higher time frame direction. Why is that? Now, let's see. We have extreme level here, extreme, extreme. All these are extreme levels, okay? Now, when you be on the side of the higher time frame direction, what happens? So we are bullish here. We have a breakout structure of a strong area, breakout structure. This is your extreme level here. When you take this entry, price goes and gives you a lot of reward to risk. And even if it reverses, it just go into another key level in order to continue. So you could hold this all the way up and then take some partials, and then you could leave the rest. Sometimes it's going to retrace all the way down, sometimes only to here and then go up. But when you are with a direction, it's going to help you a lot to, catch much higher reward to risk, other than catching the reversal, which is against the higher time frame direction, which is, for example, here, price comes to this level, goes lower here to this level, and then breaks the high again. That is catching a reversal. It can work, and I do trade it a lot, but I always need to have an understanding of what level I'm taking the trade off. If it's continuation, if it is with the higher time frame direction, that means I can actually extend my take profit and I can leave some runners for the future. But if it's only a reversal one, then I'll be more conservative with my take profit, and I'll make sure that whenever price goes to any SNR level, for example, or any key level, then I'll make sure to take some partials there and maybe fully close the position. So it's always better to be with the higher time frame direction. However, we need to understand that the market moves from a key level to another. That's why sometimes you don't even need direction, but it's always better to stay in order to have higher reward to risk. But any valid key level will give a reaction to another key level, so maybe to this level only. So price will just pull back here and then go up. It could also pull back from here all the way to here, and we're going to see the examples. So my suggestion is try to be always with the direction if you are not experienced enough. But if you know what you're doing and you know that the market moves from a key level to another, and you know what level you're taking the trade off, is it continuation or is it a reversal? That just limits the expectation and give you an expectation of the expected reward to risk. So that's you can predict if it's going to give you 3-1 or 10-1. That all based on the direction, if I'm being with or against it. Now, before going into the key level, I just want to say that you don't actually understand liquidity. You are just assuming that every high is a liquidity and then every low is a liquidity, when that is not true. I can guarantee that a lot of times you've taken a trade, for example, maybe here, and then you targeted this high. What happened is price going up, and then you get your 3-4-1, and then as soon as price comes somewhere in here, it just started rejecting, and then you take break even when price was really close to that, what do you call a liquidity level, when in reality not every high is a liquidity level. Yes, it could be in other time a liquidity level, but in some specific time it's going to be a strong level that's going to reject price even before it gets to this level. It's going to get rejection from here, and a lot of people call it SMT, that sometime EU, for example, takes the high, and then GU does not take the high, but there is reason behind it, and it's not only the SMT, because these by themselves are strong level, especially based on what happened before this high. So sometimes we deal with strong highs and lows, and other times we deal with weak highs and lows. But what I'm saying is that not every high is a liquidity level. So if you want it to be staying on the safe side, and then you don't want to this scenario to happen to you just before price coming to this level, it reverses, then you can set your take profit at this level here. The closing of this candle, the opening of this candle, this is where you take profit. And why? Because this is a strong zone here. This is a strong level here. And the key level that I'm going to be focusing on is this key level here. This is where a lot of times, now sometimes price is going to go up, and I know why it goes up there, and sometimes it's only going to come up here and then go lower. But do not assume that every high is a liquidity level and every low is a liquidity level. It's the same as assuming that every engulfing candle is going to establish a bullish move now. It's going to continue forever. And then it's the same as, assuming that every imbalance is going to be pushing price higher. That is not going to work. You need to understand that liquidity is the same as everything. Sometimes it's going to push price, sometimes it's going to reverse price, and other times it's going to continue the same direction. So sometimes price is only going to come here, go lower. Sometimes price is going to go above and then reverse. And another times it's going to go above and then find support here. So you need to understand that it's not only one outcome, same as imbalances and the same as any other way of trading. It's all based on probability. So that's why you don't understand liquidity. Now we know what is the key level that we're talking about. And this is the key level, the official one that I trade based on every day. And that is the level that I also teach my student to focus on using the edge model. Now, when we have price going up, and it depends also on the context. So that means not every candle going to the upside and then downside, bullish and bearish. That means we have a key level. Yes, it could give a reaction, but we're going to focus on the high probability ones. Now, this is the key level here. When price comes to this level, we can look for shorts, we can look for confirmation here. And same thing, when we have a bearish candle and then a bullish candle, this area here from the body of the bearish candle to the lowest low. So if the low here was here, then it's going to be this big. This is the zone. And we can take confirmation when price pull back to this level to the upside. That is the key level. That is the, I'll call it the extreme level, because it's actually the only level that you can have high reward to risk from. And then if price, so what is the worst thing here? That you set your stop loss slightly above. And if it goes above, that means you were wrong about that direction. And then you can take the opposite side, for example. And here, if it wants to go higher, then it needs to respect this level in order to continue higher. And if you notice here, the zone, sometime it's the refined one, and it's the smallest zone that you can have, that if it works here, goes up, you can get a lot of reward to risk of this. Now, don't get me wrong, sometimes price is going to take the high and the reverse. Sometimes it's going to totally violate this level. Why? Because it's all about probability. We need to focus on the high probability ones in order to succeed when trading any key level, not just the extreme levels. And that is what I teach my students all the time, based on the edge model, that we only focus on the high probability ones. Now, if you want to focus on that specific level, let me introduce Edge School for you. After testing almost every strategy over the past 7 years, I put together everything that actually works into what I now call the edge model, a simple universal framework based on real market behavior and not overcomplicated systems that overpromise. Edge School brings this model to life through core lessons, a focused community, advanced live and recorded workshops, and a full library of essential resources, all designed to remove noise and build true consistency. Now, Edge School isn't for everyone, it's only for traders committed to long-term growth. If that's you, I would genuinely love to welcome you inside. Let's get back to the video. Now, let's go over some examples on how the extreme levels can actually change your life and then how to trade off it. And we're going to look at some examples that works and other examples that don't, and we're going to discover why it does not work. Now, this is the euro dollar on the 4-hour chart, and that is the time frame that I always, most of the time use and blend it with other time frames. And I've taken a lot of trades using the extreme level and using the edge model. What do we have here? That is a level, and that is a trade that I've taken using the edge model from here all the way up. And you see, it did not last much here, even though, because we got reacted off another key level all the way up here. And this is the major trend was to the upside. This was, yes, with the pullback here, the trend of the pullback, but then we got reacted at this level going up. Now notice what happened here. Reaction of a extreme level. What do we notice here? Another extreme level. Another extreme level. When a lot of people are going to do what? They're going to say, oh, that is the liquidity level and we want it to be taken. Not get taken. It's not taken. Same level here. Not taken, and only respect to that level. Going lower. We have this liquidity level. Not taken. Now, yes, sometime and after time, and as I said, it depends on the time. The time that we're creating the extreme and the time and the context, the market structure that we're having. So you see, after time, yes, it gets taken as liquidity. But again, you see here, extreme level respected, another extreme level here that is respected. All you do here is doing what? You're focusing on extreme levels, the major ones, and you're basically catching the move of one key level to another key level. That's all. That's all. So, for example, you see, same thing here. A lot of people are looking at what? This liquidity level to be taken here, because we have equal lows. What happened though is price coming to this level, pushing up. Same thing here. This level going up, this level going up. So I hope that you see the pattern here is that we create what I call the extreme level, is price going up, for example, or let's do price going down, for example, and then going up, and let's assume that green. So we have price and a candle going lower, candle going above, and these are the wicks. We're gonna focus on the wicks here in order to push price higher. Now let's assume that we have this extreme level here. Now if you're one of my students, you actually know exactly how to take entry from here instead, not just right here. Okay, and same thing if we take a look at this extreme level. So I'm gonna have it bearish here. So this extreme level, yes, this is the whole extreme level. But if you're one of my students and in school, you would know how to get your entry around this level. Okay, and same thing here. So you see, extreme level respected, and you would know how to get in from here. Same thing, another extreme level, getting respected. So using the replay, we can see that we push lower, price going up, actually candle going up and candle going lower, creating this extreme level, which is in this case a bearish one. We go 15 minutes or 5 minutes, whatever you prefer. And you'll notice that if we play the price action, whenever price gets there, you can take your confirmation. So when talking about the confirmation, we have our extreme level. There are some confirmation entries that I teach in ed school, but you can use your own. And these are confirmations, the one that I use. I've backtested endless of hours and then put all my experience in order to put it this way. But you can use your, for example, market structure shift entry around this level. You could also use, creation of imbalance. You could, you have the freedom to look for any confirmation. So if we look at this level here, that is the extreme level that we're talking about. This is going up. Actually, let me just get back here. So the extreme level, yes. So that is the one. Gotta remove this. That is the extreme level. We go back to 5 minutes, for example, and then let's see how price respect that level. So exactly respecting that level, going lower. What do we have? Market structure shift. What you can do is look for any entry. So mainly for my students, I suggest taking some entries from here. All right, with the stops above. Now you could also look at the 15-minute for more safe entry. All right, so in this case, it doesn't look like price pulled back here. All right, so okay, exactly there, I guess. We go back to 5 minutes. So yeah, should have been here, exactly there, come in there, and then your stop loss just slightly above the high. You could also refine more to, if you know which level gets tested already and which one is not gonna get tested, then you can have tighter stop loss. But in this case, let's put it just this way, and then back to the 4-hour. Now you can target another 4-hour level, for example. In this case, I think this was not, for me, this was not the best entry. Now price goes lower, back to the entry. So if you notice how strong this level is price coming back to it again and then pushing lower. And that is just a nice trade. Now you could have gotten a much smaller stop loss. It depends on the levels that we're having here. And then that is what happens. The price goes back again, exact same level with another extreme. Now going back to this, and then we have another one here, extreme level. And we want the extreme level to be respected with a wick most of the time. And we also have this one that is just an extreme level. And, a lot of times we can get an entry from here. Not exactly from there, but we can get from here. It depends on your experience. 15 minutes, you could look for your own confirmation entry here. Take it from the extreme level to another level. That's all about it. So you have the choice to use your own confirmation entry. You can get experience with the extreme level. But all I do every day is simply trade off an extreme level into another extreme level, and then same thing over and over. Now talking about the significance of reward to risk when it comes to the edge model. Now, even though I really try to always have a higher win rate, but you need to understand the relationship between win rate and reward to risk. So here on the x-axis, what we have is the reward to risk, and here we have the required win rate to be break even. So we're not taking about profitability here, we're taking only about break even. So when we have, just because we're using the edge model, usually I do have an average of around 4-to-1 to 5-to-1 average reward to risk. So all you need in order to be profitable using this graph and thinking about the relationship between reward to risk and win rate, all you need, if you have about 5-1, or let's do 4-1, about 20% win rate. But you need to take care of your psychology in order to let this probability happen. Because if you have, let's say you have 20% win rate, but then your psychology isn't that good, that's going to ruin the whole thing here. Because anytime you lose, you affect the graph here. You're not executing your plan. What you're doing is you're executing your emotions. Now, if you don't like the high reward to risk, you can always aim for example, 2-1. And all you need is around 30% or just about 30%. And if you're aiming for 1-1, that is 50%. And it's a balance between the two. So feel free to, you should know your psychology, what level that you're reaching now and which win rate fits you more, and then adjust that on the reward to risk. So even you can actually look for much lower reward to risk and then still have a good win rate just using the same exact level. But you need to find that sweet spot, that balance. So in summary, even if I lose a lot, I can still make up all the money because I'm aiming for more. Every time that I lose $100, for example, and if I win, I make $500, $600, and sometime more, sometime 1,000, for example. So that is 10-1, 9-1, 7-1, and I do lose a lot, but I can make up all that in one trade. That is just an example. So that's it for the video. Thank you so much for being here. If you like the video, then make sure to hit the like button, subscribe to the channel, and share the video with your friends. If you want to discover your edge and simplify your trading and learn the edge model, make sure to check Edge School in the description. That's it for today, and I will see you in the next video.